and thank you for joining us for today's Monitor Explained webinar. We'll be taking a deeper dive into the fourth and final issue of Monitor 2025, which is our quarterly report that gives you an up-to-date view on current non-energy costs. So a bit of housekeeping as normal. Session is being recorded, so it can be shared with you after, and for anyone who couldn't join us live to watch on demand. If you do have a question, please use the Q&A function throughout. And at the end of the presentation, we'll be allocating a bit of time to run through these with the experts, and any we can't answer, we'll follow up after the session. So if you are a customer and you haven't already got your copy of Monitor just yet, you can contact myself or your account manager for a copy and access the helpful guide by logging in or signing up to EDF's Market Insight portal. The address can be seen on the screen right now. So the Market Insight portal is a gateway to regular updates, and it's there to help you make the right decisions for the business and have access to quality data and expert analysis to help you navigate complex energy market. So my name is Rich Suter. I'm Senior Account Manager within EDF, and I'll be hosting today's session. Joining me are technical experts from the Wholesale Market Services team, David Edmonds, Head of Pricing and Valuations, Hugh Boyle and Dan Minifie, Lead Analysts from the Pricing and Valuations team. So jumping straight in, we'll probably ask David if he could start with a quick overview of what we're going to be talking about today.
Yeah, thanks, Rich. So on the agenda that we've got here, as usual, we'll cover what's happening with April 25 charges at the moment, any updates that we've seen, but we'll also take a bit of a look forward to April 26, as it's only a few months until we start the next charging year that's there. We'll then come on to an update on TNUoS, particularly focusing on Ofgem's final determinations that they made a couple of weeks ago. And then we'll come on to an update on the RO obligation level to hopefully finish with some more positive news before we go into a Q&A. So moving on to the overall update on energy costs for both this charging year and next charging year. We'll step through these one by one as usual, just to give you the latest news on each cost. So starting with BSUOS, which is the Balancing Services Use of System charge. We are showing a very similar view to last time here, and the reason for that is that the low rate reflects NESO's fixed rates that they set at the end of last year to cover both this summer that's already gone and the winter that we're currently in. So the low rate reflects those charges that have been published, and the high rate just reflects that there is a risk still that those rates could be opened up. That was looking like a slightly bigger risk earlier in the season, particularly with some high costs that we saw across October and into the first half of November. What we have seen more recently, though, is some lower costs, particularly over the last couple of weeks. That has meant that that position has improved a bit for NESO. So where they'd seen higher costs than they were expecting, they had actually at points moved into potentially having a negative cash position. Now, that doesn't immediately mean that the rates need to be adjusted and opened up. NESO can cope with up to around £300 million of negative cash compared to the rates that they've set. But obviously, when they started to move into a negative position, that does make the risk a bit more likely that they could have opened it up. So if they did get to a position where they were running out of cash and there was a possibility they wouldn't be able to pay generators, they do have the right to adjust those rates. Where we're at now, it is looking like a decreasing risk. But as we move into the later part of December, we can, at times, if we get windy weather, particularly when there's low demand, see quite a lot of costs very quickly. So we are just keeping a close eye on that. So there is still a possibility it could happen, although probably a decreasing risk at the moment. Looking ahead to April 26 for that charge, there is a relatively small increase that we expect to see. That is really driven by expectations of what NESO will set as rates at the or later on this month, possibly at the end of this week, and where we continue to see increasing renewable generation requiring greater actions for NESO to take. That tends to drive up costs year on year, although there are other variables that can make that a bit more volatile. Moving down to the CFD cost, or the contract for difference cost. So this pays for subsidies for renewable generators. It acts as a top-up to wholesale prices. So generators are given a fixed strike price, and that is made up through a market reference price and a subsidy top-up to that. This means that the cost is very closely related to wholesale prices, and if we do see movements in wholesale prices, it does drive a movement in the CFD. The range for April 25 on this one has narrowed significantly, and that's just because we've got another 3 months of outturn data since the last time we saw this view. And we are still expecting that to be closer to the high end of this range, so kind of in the 11 to 12 pounds a megawatt hour type level. And the reason that we have a bigger lower range on this is because of that link to wholesale prices, and that wholesale prices could rise by more than they could fall, particularly across the last few months of the year. If wholesale prices did rise, then you would see a smaller top up that's needed for those generators. If wholesale prices fell, there would be a bigger top up that was needed. And so you could see a bit of an increase in the CFD cost. But because of where wholesale prices are at the moment, there is more room for them to increase than decrease. So there is a possibility of a bigger drop in CFD than there is of an increase in the CFD for the rest of the year. As we look ahead to next year, April 26, we are expecting a bit of a bigger increase than compared to TNUoS, about a 10% increase roughly. Two key factors that drive this. One is that we're getting more renewable generation come onto the CFD scheme, as particularly offshore wind farms get built. So the more capacity is there, the bigger volume there is to potentially pay subsidies to, and the cost starts to go up. The other factor is, as we look ahead, there are slightly lower wholesale prices. We are seeing the market continue to fall a little bit. So the lower wholesale prices requires a slightly bigger top up to pay to those generators as well. Then the capacity market. So this one hasn't really changed for the April 25 view much. We are waiting to see what the outturn chargeable demand looks like between 4 and 7 p.m. November to February working days. Once that's known, we'll have a clearer view of what the charge actually outturns at, but it is a fairly narrow range to start with, so not too much uncertainty there. The big news really on this one, well, they're not new news, something we've been talking about for a little while, but looking ahead to April 26, we are expecting there to be a big increase, and that is reasonably certain that it will be a big increase. There's still a little bit of variability that could come through, but where there is an auction that determines most of the capacity market cost that happens 4 years before delivery. That is already confirmed. We can already see that there's going to be a lot more cost coming through. And that is a particularly interesting one to look at, considering it's only charged on a small amount of demand at winter peak times in the evenings. So roughly a 90% increase at the moment expected year on year. But it is an interesting one in terms of it will affect different people at a different amount depending on when you tend to consume, and also creates the opportunity for people to avoid consuming at peak times when everyone else is consuming, help out the wider system and NESO by doing that, and also avoid some of that cost. So that is an interesting one to look at as it continues to grow, particularly into next winter. TNUoS, there's not much to talk about on distribution charges here. As we said, for a while, the rates were fixed some time ago for this charging year. They've already been fixed for the April 26 year as well, and they are at a very similar level for that year. So not too much to focus on there. On the feed-in tariff or FIT, a small decrease in the April 25 year that's come through on that. And that is following some data on the reconciliations for the previous charging year of April 24 and showing some lower load factors typically on those sites that's been adjusted for in here. So that has come down a little bit. Looking ahead to next year on the feed-in tariff, a small increase, again, mostly driven by inflation that we expect to come through as that scheme was closed a number of years ago. And so it's fairly stable other than being inflated year on year. On the RO, Renewable Obligation, again, no change for April 25 because those rates had already been confirmed. And actually towards the end of this, we'll give an update on April 26 that's come through. That actually means we're now expecting the level of cost to be very similar next year, where previously we had been expecting a bit of an increase. So there's some good news there that we'll cover later on. TNUoS, again, is one that we'll cover in the next topic, but for April 25, fixed some time ago again for the charges this year. Looking ahead to next year, as we've spoken about across a number of these webinars and reports now, we are expecting a very big increase. There has been a bit of an update for Ofgem, so I won't talk about that now, but he will cover what we've picked up from that. And we're particularly looking for final tariffs, hopefully published, draft tariffs hopefully published this week, final tariffs published at the end of January to confirm what those charges will be for April 26. And then finally, two smaller charges at the bottom. So the energy intensive industry support levy. So this was brought in a little while ago as a charge to fund compensation for network charges for energy intensive industries. We have had a bit of good news on this for the April 25 year. So previously we had a higher range on this one, where there was a policy change that was being brought in to increase the amount of compensation for those industries from 60% to 90% of their network charges. That had been suggested that it could be backdated to April 2025 in terms of the charges that would come through. That has actually now been decided that it will come in from April 2026 rather than April 2025. So in terms of looking at the April 25 charges, that risk has gone away a bit. So it's a much narrower range now, and is good news. For April 26, looking ahead, obviously that increase is still coming in, which is part of the factor for that 100% increase that we're showing there. The other reason is TNUoS increasing by so much, and TNUoS is one of the charges that is compensated through the EII support levy as well. So those two factors mean that we're expecting a big increase there, albeit from a fairly small base. And then finally, the nuclear RAB charge. So that has now started to be incurred as of a few weeks ago. There's been a couple of very small changes to this one of just a month's delay or so to the charge coming through. And the big 200% increase that's shown here isn't actually the chargeable rate changing all that much. It's just reflecting that it's only being charged for 4 months of a 12-month period in the April 25 year, and then will be charged for 12 months of a 12-month period in the April 26 year. So that annualized cost therefore triples roughly compared to what we're seeing for this charging year, where it's only been charged since the beginning of December.
Thanks. Thanks for the overview, Dave. What's the overall effect going to be for our customers, and how are they going to see these increases on their bills from April 26?
Yeah, so the big four to focus on, four with the big percentage increases here, two of them larger, two of them much smaller. We've just moved on to this view that we've included, where there's been some questions about it in previous webinars. So I thought it would just be helpful to share this, but you can also find this in the monitor report. This is showing April 2025 charges, but just to give you a sense of the size of the different elements on the bill. The big changes that come through are to TNUoS and the capacity market supplier charge, CMSC, which are the darker green and the lighter blue colours on here. Where they are roughly doubling, not necessarily quite doubling, but roughly doubling, you can see that they already make up a fairly big proportion of the bill in April 25. So doubling those will add quite a lot to the total non-energy cost bill. On the EI support levy and the RAB costs, you see they're much smaller elements. So even though, again, they show a large percentage increase, they won't have quite such a big impact on the total bill overall. But in terms of kind of overall impact, and for a typical average customer, so this will vary customer by customer, but we're probably looking at something like a £25 a megawatt hour equivalent increase. The TNUoS charges, a lot of that's on the standing charge, so it won't actually come through as a unit rate increase, but as an equivalent around that sort of £25 a megawatt hour type magnitude. Could be a bit bigger for some, could be a bit smaller for some. And that is likely to take the proportion that non-energy costs make up from the 60% that's shown here to probably around 70% of a typical bill. So adding about 10% overall onto that. Also, in the build up to this, we did have a question that was submitted around the probability of upwards or downwards revisions against our views. So the numbers that we share here are our best view, and so should have a roughly equal chance of increasing or decreasing. As sort of covered on the previous slide, there are still lots of uncertainties, so costs can go up, costs can go down against our current view. but this should hopefully be a fairly central view with equal likelihood of increasing or decreasing from what we've shown.
Okay, let's move on to one of those big increases then. Here, I've seen a lot of media coverage, and I dare say our customers have as well, around Ofgem's TNUoS final determinations. Are you happy to talk us through this update and explain how this is going to affect us in a bit more detail, please?
Sure, can do. So, yeah, apologies for people who are on this who may have heard me talk about this 3 months ago, and dare I say probably 6 months ago as well. It's been in the news for a long time and will continue to be well into the new year, unfortunately. But I'll try and cover off an intro. So apologies if it's a bit of a duplication for some people, but very quickly, what is TNUoS? It's a transmission network use of system charges. These are the charges that pay for the maintenance and for the expansion and reinforcement of the transmission network. I guess because the transmission network is a natural monopoly, you can't get your electricity from another national grid. It is a regulated business, so it's subject to price controls that run for every 5 years. And there's an acronym there, RIO, which is just the name of the framework, the price control framework. And last bit of background, so how do customers see TNUoS on their bills? David just alluded to it there, but it largely comes through on the standing charge as a banded pence per site per day charge is how ultimately these costs are recovered from customers. So what has changed? What has been in the news recently? We are on the cusp of another price control period. So this one will be called RIO T3. It will begin from April 2026. And what got published earlier this month was Ofgem's final determination or decision on this price control. So these determinations are sort of the governance and the framework that will surround the price control, how much investment will be spent, and what sort of financial parameters are that investment subject to, things like weighted average cost of capitals, that sort of thing. So Ofgem did give its draft determination earlier in the year, sort of June, July time, and the final determinations are broadly in line with those. So a bit of continuity, some tweaking at the edges, but really, yeah, in total investment that will be spent in new price control, Ofgem says this could still exceed £70 billion. So with at least 44 billion of that sort of in various stages of commitment. Unfortunately, although the price controls are reviewed only formally every 5 years, investment happens in real time. So there's a bit of a blur, a bit of a low overlap there. But compared to the current price control RIO 2, we've seen about, it's not quite over yet, but we've seen about sort of 23 billion of investment to date. So massive increases in investment over time. And the final determinations largely back up what happened in the draft determinations there. And Ofgem's own analysis of that is that this investment, these final determinations could see bills, in nominal terms at least, broadly triple by 2031. And so I say bills, TNUoS bills, not total customer bills. They do expect, as part of this investment, that other parts of bills will come down as well. For instance, if you build a lot of net zero infrastructure and help decarbonize the grid, you reduce gas dependency, which should help bring wholesale prices down. And equally, if you're helping reduce sort of bottlenecks and congestion and constraints on the grid, you can hopefully bring down the TNUoS costs as well. So there should be offsets, but in isolation, yes, TNUoS costs broadly tripling by 2031. I guess to put that in volumetric terms, because as David again mentioned earlier, it's on the standing charge, it can be a bit abstract. If you took that sort of money and turned it into a sort of pound a megawatt hour equivalent, today TNUoS is about sort of 15, 16 pound a megawatt hour. You could see that get up to about sort of, again in nominal terms, sort of 43 pound a megawatt hour by 2031 at the end of this new price control.
Thanks, Hugh. So what about between now and 2031? What changes do you think are going to be happening then?
Yeah, good question. Yeah, I appreciate it. It's a bit tricky because Ofgem don't set the tariffs themselves. They've set the governance and the framework for the price control. It's now on to the transmission system operators. So that's National Grid in England and Wales and their Scottish equivalents in North and South Scotland to set tariffs subject to those parameters of the final price control. And investment does not equal TNUoS tariffs. So although I sort of talk about 70 billion of investment, up from 23 billion in the current price control. There are some different levers those transmission operators can pull. They can recover it all from customer bills, or they can recover some from equity funding or debt funding, while acknowledging that some of those latter options will have financing costs, which will ultimately increase costs for customers over the longer term. So there are trade-offs in that, but generally it will be a little bit of both. And what we saw back in September from the sort of, not draft tariffs, those are still to come, but an initial view of the tariffs was that, yeah, you could see still significant increases from April 2026. So if you look at the chart here, you can sort of see a big sort of spike in the projected revenue recovered from TNUoS tariffs, so roughly double from customers, acknowledging that about £1 billion in both the April 25 and April 26 years will be recovered from generators. So you've got about 4 billion recovered from demand customers in the April 25 year, and around 8 billion recovered from demand customers from April next year. So again, you could see TNUoS tariffs, again, trying to pull it back into volumetric equivalents to make the comparisons a bit easier, about £15, £16 a megawatt hour currently, going up to roughly £30 a megawatt hour from next April. There could be some rephasing. So Ofgem has, as I said, tried to sort of tinker around the edges with their final determinations. They may try and move some of that investment back slightly, so rather than leaning it towards April 26, more onto sort of April 28 onwards. But from what we can see, that's going to be in the low hundreds of million at best when you increase in total investment and total revenue recovery from customers by billions. So it may help a bit, but I think we are still, yes, expecting to see very large increases from April, potentially double, and then increasing as you go through the price control period.
Okay, thanks, Hugh. I mean, what are the next steps with setting the TNUoS tariffs?
So as David sort of mentioned towards the start, we are literally waiting any day now. So NESO typically publish their draft tariffs for TNUoS at the end of November. They have delayed it this year to take into account these final determinations to make sure they're reflective. So we're expecting them this week. It could be any day now, although I suspect it will be probably Friday, which means I guess a lot of people will, after Friday, maybe off for holidays for a couple of weeks. So really it'll be in the new year when the dust settles on that. And then following those draft tariffs, it'll be very quick turnaround for the final tariffs. Those have to be published by the end of January. That will give complete certainty on where the April 26 tariffs lie. Although, again, the draft tariffs that will be published and the final tariffs will be just for the April 26 year in isolation. To look at how the rest of the price control is going to pan out, we'll be waiting until April next year, where NESO will publish their annual 5-year forecast of TNUoS tariffs.
Okay, thank you. I mean, it's obviously a hot topic. Is there anything else worth mentioning on TNUoS before we move on?
I suppose very quickly, just talk about what didn't happen as well. So as I said, like these final determinations were continuity with the draft determinations. The various options that we could have seen happen were, well, one is you delay net zero by delaying this investment. It would bring down bills, but create wider costs in the future. That didn't happen. So all that investment is still planned, which is why there is that continuity there. The other option that we may have seen was that, well, fine, acknowledging that this investment has to happen for net zero, could there be some alternative support for bill payers, some other mechanism to help out? We haven't seen that either. At least so far, it's only been limited to domestic customers. So for those who saw the sort of government's budget at the end of November, there was some relief for domestic customers on their renewables obligation. So government is underwriting 3/4 of the cost of that for the next 3 years. And also the energy company obligation scheme, which helps with home insulation and upgrading the energy efficiency of domestic homes. That scheme has been scrapped from April as well, which will again have a reduction on bills, but again the cost of that scheme were only recovered from domestic customers anyway. So again, two benefits for domestic customers that should help offset this TNUoS increase. But no, so far at least we haven't seen any kind of alternative support for non-domestic customers.
I think just before we move on, there's been a few questions coming to Q&A that might be worth us just
sure.
dealing with now. So obviously the first couple, Hugh, and then I'll come over to you around some of the TNUoS specific questions. So one that says, will the increase in energy cost be reflected as an increase in the unit rate or the standing charge or both? I think in terms of the TNUoS increase, it'll be in the standing charge. In terms of some of the other items I was talking about that aren't really new news, they've been there for a while, but will come through, they will more be in the unit rate. So I guess the short answer is both, but it depends which cost items you're looking at. Also a question around whether because the TNUoS increase obviously looks very high, whether anyone's pushed back on the initial view of the tariffs. I think it's fair to say there's been a lot of discussion around the industry and challenge from suppliers, particularly in the level of what this means for charges and the late notice that came through. So I think some of what Hugh mentioned in terms of Ofgem indicating they were trying to reduce the costs as much as they could for the April 26 year is directly as a result of some of that challenge that has come through. There is a balance to be struck, though, in terms of this is investment that is ultimately deemed to be needed. So there is a cost that has to come through. It's about trying to make it as manageable for people as possible and done in a sensible way that people can react to fairly. And then here probably continue this one that just clarifying around the difference between the final determinations, the draft determinations, and the rates that will actually ultimately be set. So I think someone just started saying that the final determinations were issued last Friday, which I think is true, and that there was an indicated a 23% lower final determination than draft determination. But I think that might be looking at one particular part of the funding that Ofgem's looked at.
Yeah, there's a lot of buckets, like basically the blank check upfront investment, and then there's various reopener pots or pots that are subject to other contingencies, but the overall amount I think is largely the same. They could also, I haven't looked too closely at the gas price controls, which are also published as part of the same package by Ofgem. It could well be that there's some of those reductions have been seen on gas rather than electricity for TNUoS. But yeah, unfortunately, we're seeing probably broadly the same. Although, as I say, it's Ofgem sets the framework. The transmission operators will set the tariffs and the exact phase-in subject to those parameters and constraints.
Yeah, thanks, Hugh. And then one final question before I hand back to Rich to move on. Do you have any view on how reformed national pricing might impact TNUoS in 2029?
I guess just to temper expectations here, I guess that's part of the remit reform, which will probably lean heavily on TNUoS to potentially mimic some of the aspects of what could have been a zonal national market. You can increase locational charges to make electricity more or less attractive, or effectively reflect system costs in different ways. Because as today, TNUoS is largely on the standing charge, it doesn't really send a signal. What it won't do is it won't change the size of the pie. So the price control, the RIIO framework is how much money is recovered from TNUoS. REMA may create winners and losers by saying these type of customers or customers who engage in these behaviors pay more or less, but it won't change the size of the pie. Unfortunately, we had expected a detailed policy paper on what, as can understand the question, what reformed national pricing might look like. That hasn't happened yet at the time on this webinar. By the time of this webinar, and I don't think it's going to happen this week. So I think we're looking into the new year for the concrete next steps on what that may look like. But I guess very quickly what they're looking for is how do you balance making charges predictable while also sending useful signals to customers on where to locate and when and where to consume electricity. So, but we don't know much more than that at this stage, unfortunately.
Yeah. Thanks. Very, very uncertain, but we will obviously keep you up to date as and when we learn more what that looks like. Okay. Sorry, Rich, back to you.
No. More than happy to let you answer the questions from our customers. So thank you both. And moving on to the final topic before we any further Q&As. Dan, would you mind talking us through the recent updates in the RO scheme, please?
Yeah, thanks, Rich. So DESNZ have recently set the GB obligation level for the 26-27 year. This has been set at 0.472 ROCs per megawatt hour. This doesn't set the final supplier charge just yet. That will be confirmed early in the new year, but it's likely to be around £33 per megawatt hour. The final number will depend on the outturn RPI inflation across 2025, as that sets the buyout price, which then sets the final supplier charge. So this obligation level is quite a bit lower than we've seen in recent years, as we can see on the chart, and it's lower than what we had previously expected as well. Previous years we've seen obligation levels sort of above 0.49 rocks per megawatt hour. I think sort of 4 of the last 6 years we've seen above 0.49, but for a 26-27 year it's much lower than that. It's about 0.47, similar to a 23-24 year as well. So the reasons for this is essentially due to DESNZ's assumptions on supply and demand. So DESNZ have predicted there will be an increase in national demand in 26-27. They're predicting roughly 4% increase of national demand compared to the last 24-25 year. And then additionally to that, they are predicting lower levels of renewable generation supply due to lower load factor assumptions for certain technologies. And the difficulty is when we try and forecast this is that essentially we're trying to guess what DESNZ are going to predict. DESNZ don't make any of their assumptions public until after they announce the obligation level, so it does make it difficult to predict. But in this case, it's good news for suppliers, for consumers and suppliers. It means a lower supplier charge. That does help to offset some of the other increases like TNUoS that we've just been talking about. Separate to that, there's also an ongoing consultation from government, which is seeking to change the indexation approach from using RPI, as is the case currently, to CPI from April 26 onwards. And this would actually apply for both RO and FIT. Reason for this is partially because RPI has been phased out by the end of the decade, so they need to do something. But also government sort of focus on keeping costs down as well. I think they're keen to do anything they can to keep costs down. So if this consultation is approved, it would reduce the buyout price being reduced and therefore a lower supplier charge. The outcome of the consultation will sort of determine exactly how much, but it could potentially be lower than the £33 that we've sort of quoted here.
Okay, thanks, Dan. And is there any update or news on the mutualisation costs?
Yeah, so for the 24-25 year, Ofgem have recently confirmed the total shortfall. So this has been confirmed as £23 million after the late payments deadline. Most of that is coming from the supplier exits of Rebel Energy and Tomato Energy. That's a little bit higher than we've seen the last couple of years, but still comfortably lower than the mutualisation threshold, which is about £87 million across GB, which means that mutualisation will not be triggered. And yeah, going forwards as well, with this high mutualisation threshold and the introduction of ROC ring fencing, it does mean mutualisation should be less common going forwards.
That is a bit of good news there. Great, thanks all. So I mean that brings us to the end of the prepared content, but we do have some questions, and you still can submit questions for the Q&A function. But we did have a few come in already and prior to the meeting. So with the recent budget announcements, what is the impact going to be on energy bills? I think we've covered this a bit already, but David, I'll probably go to you on that one.
Yeah, and I'll probably combine it with another question that's come in around what EDF are doing to engage with government on these costs. So I guess on that one first, and I'll come on to the specifics of the budget. So we are very active in discussions around the industry, both whether that's through bodies like Energy UK or bilaterally with DESNZ, DBT, Ofgem to suggest policy options and discuss policy options with them in terms of how these costs could be paid in different ways and different mechanisms, what could be done to manage them. Ultimately, the government, though, will then have the final say in setting what they believe the policy will be. And then we'll come back into the discussion with them through consultations to feedback on bits we like, bits we don't like, about how those are recommended, and then ultimately trying to help them figure out the detail of how to implement the policy decision they come up with in the most efficient way. So we are definitely there, advocating for all our customers and advocating for our view of the right way to try to structure a lot of this. In terms of specifically the budget, so the key thing takeaway is from our understanding of this is it will only impact domestic users, not business users, from the measures that were talked about in terms of the energy company obligation and the reductions to the renewable obligation supplier costs. So the energy company obligation is a scheme that essentially pays for energy efficiency measures to be installed in domestic customers' homes, and that is charged on to domestic bills only. So that being scrapped as a scheme will reduce some domestic user costs, but no impact onto business user bills. And then the second measure of the renewable obligation supply cost. So again, only for domestic users, but the proposal is to cut that by 75% for 3 years. It'll still be suppliers paying 100% of the RO supply cost, as we understand it, but with only 25% recovered from domestic users and 75% recovered from the government, ultimately via general taxation rather than energy bills. From April 26 until March 2029. So on your own domestic bill, you will see the impact of that come through. But as a business user, there is no impact as a result of those specific policy measures.
Thank you, David. Another question that we have is, how does the delay to the RAB scheme impact customers, and how long is the lag between RAB, interim levy rate, and the final actual RAB rate? Love all the acronyms in that question.
Yeah, I can take this one. So yeah, there was some news recently that Sizewell C reached financial close. This was on 4th of November, slightly later than the initial plan of 1st of November. Yeah, additionally to that, Ofgem have confirmed the allowed revenue for the first charging year, which will run from that start date of 4th of November up until 31st of March 2027, and that's been set at £1.4 billion. Despite it starting 4th of November, the Low Carbon Contracts Company, who administer the scheme, they've confirmed that the levy collection will only commence from 1st of December, which is again one month later than initially planned. So that means basically in November there will be zero cost, down from what was initially expected of around £3.50. Then from December onwards, that allowed revenue will be smeared over approximately one less month, which means there will be an increase to the levy of about 20 pence per megawatt hour on average each month. So that means rates will be around £3.70 per megawatt hour in the winter months, while in the summer months with lower demand, that rate will be higher at around £4.70. So overall, the kind of net change to the total RAB costs is relatively small, but there may be some impact due to the timing of those payments, which might impact customers differently depending on their consumption profile. And I guess going back to the sort of the lag question, so the final levy rates are based on reconciled demand, and they will be reconciled to a daily granularity. They are reconciled, the levy rates are reconciled at the end of each quarter. Normally, we think the rates should be reasonably accurate after the second quarterly reconciliation, so which means up to like 6 months after settlement date, they should be reasonably accurate.
Okay, thank you. And we have another question came in. What will be the impact of the British Industrial Competitiveness Scheme be on bills for other consumers? don't know if Hugh would be able to.
I'll give it a go. So this was included as part of the government's industrial strategy early in the year, although the formal consultation for this launched just at the end of last month. It intends to create some support for a limited number of largely manufacturing businesses. I think the consultation's outlined around 7,000 or so odd businesses will benefit from exemption to some policy costs. So namely the RO, the FIT scheme and the capacity market schemes. So not unlike the existing energy intensive users or EIIs, although critically these new tier of businesses will not get exemption from the CFD scheme. What that means for everyone else is that if there are some users who are not paying towards these schemes, everyone who's not exempt will pay a bit more. And that seems to be the mechanism that is being proposed to give these exemptions, is these customers will have direct exemption from these costs, which will effectively push up the unit rate for everyone else who have a smaller charging base to recover these costs from. Whereas in the past, the alternative could have been to create a new non-energy cost, as we saw with the EII support levy, where that pays for the network compensation costs for energy intensive users. It seems like it will just be high unit rates for everyone else. And now the consultation is still ongoing, and I believe the implementation date targeted is April 2027. So it's not something we're going to see from April next year. It'd be from the following April, but it will push up costs for everyone else. And the exact impact is hard to pin down exactly. It would depend on how many businesses get these exemptions, but it could be in the sort of small sort of hundreds of millions of pounds of years per year, sorry, of avoided cost for these new businesses. So recovering that from national demand, you could be looking at least a couple of pounds, £2-3 a megawatt hour effective increase across those three costs for all non-exempt businesses. But the details will sort of come to light as the consultation carries on.
Okay, thank you, Hugh. I've seen some other questions flag up, and yes, the slides will be shared. They'll be on our TalkPower website, and the recording will also be live there for you to view afterwards. Another question just came in, and I put this to the panel. You mentioned that third-party costs would go up to 70% of the bill, currently 60%. Do you think this will be a gradual increase up to 2030?
So I think probably what you'll see is quite a big step change from April next year, this coming April. And then from there onwards, it partly depends on what wholesale prices do. If wholesale prices stay at levels they're at currently, where they do decrease a little bit year on year, that would also encourage the sort of increase in the proportion for non-energy costs. But then we do also, in the longer run, under current policy measures, expect the non-energy costs overall to continue to increase year on year. The other big variable that's in there is what happens with total national demand. So if we see total national demand increase through new use of electricity, things like data centers you hear in the media, things like hydrogen, electrolysis, those sorts of measures, or electric vehicles, that could dilute some of the costs and spread it over a larger charging base. That could mean some of the rates do come down on the non-energy cost bit, which could then work the other way. But yeah, currently we would expect it to continue to be a gradual increase, to a large extent driven by the TNUoS increases that he was talking about earlier.
Okay, excellent. Well, I think that is pretty much all the questions we have open at the moment. So thank you for all the questions, and thank you to our presenters for sharing any insights today. But before you go, we'd love to hear your feedback to help us continue to deliver the right content for you. So if you could give us a minute of your time, and a survey will pop up when you leave the webinar for you to complete, we'd appreciate your valuable feedback. And please take a look at our program of webinars across the year, next year, there to keep you informed on the latest power market and non-energy cost updates. You can register to attend any of these by heading over to edfenergy.com large business and clicking the TalkPower events page. Power Market will be next early in the new year, and the dates will be published shortly. If we didn't answer any of your questions today, please feel free to get in touch. Our details are on the screen now. You can email us at letstalkpower@edfenergy.com. And then to stay in touch, please follow us on our dedicated EDF Business Solutions LinkedIn page. Thank you very much for joining us. Hope you have a fantastic festive period and a very happy new year. And hopefully we will see you in the next quarter.
Thanks, Rich. Thanks all.
Yeah, thanks, Rich.
Thank you.
Yeah, bye.